Chapter 23 explains flexible budget and standard costs. The learning objectives for this chapter include to prepare a flexible budget for the income statement, to prepare an income statement performance report, to identify the benefits of standard costs and learn how to set standards, to compute standard cost variances for direct materials and direct labor, analyze manufacturing overhead in a standard cost system, and record transactions at standard cost and prepare a standard cost income statement. This chapter builds on your knowledge of budgeting. A budget variance is just the difference between an actual amount and the budgeted figure. Managers use variances to operate a business. It is important to know why actual amounts differ from the budget. That enables managers to identify problems and decide what action to take. Objective number 1 is to prepare a flexible budget for the income statement. The master budget is a static budget, which means that it is prepared for only one level of sales volume. A static budget does not change after it is developed. A variance is the difference between an actual amount and the budgeted amount. The variances are classified as either favorable if the actual amount increases operating income, or unfavorable if the actual amount decreases operating income. A flexible budget summarizes costs and revenues for several different volume levels within a relevant range. Flexible budgets separate variable costs from fixed costs. It is the variable costs that put the flex in the flexible budget. To create a flexible budget, you need to know budgeted selling price per unit, variable costs per unit, total fixed costs, and different volume levels within the relevant range. This exhibit is a flexible budget for Smart Touch's revenues and costs that show what will happen if sales reaches 5,000, 8,000, or 10,000 DVDs during June. The budgeted sales price per DVD is $12. The budgeted variable costs are $8 per DVD and a budgeted fixed cost total of $20,000. Notice that sales revenue, variable costs, and contribution margin increase as more DVDs are sold. But fixed costs remain constant regardless of the number of DVDs sold within the relevant range of 5,000 to 10,000 DVDs. Variable cost per unit and total fixed costs only stay constant within a specific relevant range of output. Why? Because fixed costs and the variable cost per DVD may change outside this range. Test your knowledge of costing terminology. A summarized budget for several levels of volume that separates variable costs from fixed costs is a flexible budget. The budget prepared for only one level of sales volume is a static budget. The difference between an actual amount and the budget is the variance. The difference arising because the company actually earned more or less revenue or incurred more or less costs than expected for the actual level of output is a flexible budget variance. The difference arising only because the number of units actually sold differs from the static budget units is the sales volume variance.